Hello, everyone, and welcome back to another episode of the What the Finance podcast, where we talk to experts to help gain a great understanding about what is happening in the world of finance and investing. On today's episode, I'm happy to be welcoming back Brian Feroldi, a financial educator and author of the recently released book, Why Does the Stock Market Go Up? Everything you should have been taught about investing in school, but weren't, which is, I'm going through it at the moment as well at university. You think, oh, finance, investing, I'm going to learn so much. Unfortunately, it's not as relevant as you think. So Brian, thanks for joining the podcast. And I guess, how are you coping with the current market volatility we've experienced?
Yeah,
Okay.
thanks for having me. It's great to be back. And I couldn't have timed the marketing of the book launch any worse. I mean, people have been joking on me online that I should have called it "Why Does the Market Go Down?" Because it's all the market's done essentially in 2020. So yeah, the last year, over a year for me has been challenging, but the last couple of months have been particularly hard. So investors have been punched in the face many times over the last couple of weeks, and I don't see an end to the barrage anytime soon.
Yeah, especially with inflation numbers that we saw today. And I think that's the thing. Sometimes it's easy to get caught up in it, but it's just trying to look back and saying, well, even though the last few months or last year haven't done well, you look at the last 10 years. And I think that's what a lot of people have been doing, and understanding that these things that they don't last forever.
Yeah, that's what you have to do. The challenging thing about investing is that we invest and live through our investment decisions in real time. So we see what's happening to our portfolio, what's happening in the world, second by second, minute by minute. And people have a tendency to want to hyper pay attention to what their investments are doing, especially new investors. If they put money into something, they tend to check it multiple times per day to be like, what's doing now? What's doing now? What's doing now? What's doing now? In so many ways, that's more harmful than it is good. And I've joked online before that investing would be better if we just got to see stock prices one time per month. Like, the psychology would be so much easier if you made an investment decision the same way you've made a house buying decision. You bought it, you never saw what was happening to the price until the day that you go to sell it many years later. If people could adopt that same mindset to investing, their returns would be better.
Yeah, it's crazy watching people on, Fin Twitter and stuff, and you just see them going crazy just by looking at the markets, and they're posting every day, and you're like, well, you got to take a step back and just understand, we don't want to be rich now. It's for the long term.
Well, I want to be rich now too,
Yeah.
but the market always doesn't accommodate what you want. The market does what it's going to do, and you have to just know that going in. So I like making money in the short term as much as anybody else, but I just know what I'm really after is money in the long term. And to make money in the long term, you have to be willing to get punched in the face in the short term many times.
Yeah, and I think that's what we talked about last time, how you sort of were looking at penny stocks when you first started because you were maybe a bit too focused on the short term and trying to return, and then maybe not looking at the companies. But now I think that's what happens to everyone. They find these things, you're like, oh yeah, I'm smarter than everyone else, I'm going to make the money. But then it's taking a step back and just learning the process, and then from there, trying to invest.
Yeah, there's a famous curve called the Dunning-Kruger curve, or the Dunning-Kruger effect, where when you go from knowing absolutely nothing to knowing a little bit, your confidence rises way faster than your actual ability does. And that certainly happened to me. As soon as I discovered what the PE ratio was, I was like, oh, investing's easy. I just got to buy a stock that has a low PE ratio, right? And just focus on that. But so many things about investing, and nothing in investing boils down to any one number, any one metric, any one thing. And then over time, as you learn that what you're doing when you're a new investor doesn't work, and eventually won't work, that's when you really discover investing isn't easy.
Yeah, that's really interesting. And as you said, I think the more you learn, the more you realize that you don't understand much about it at all, but it's just trying to, put yourself in a position where you can invest for your own needs and your own wants in the future. But yeah, I guess, we mentioned the book and how you've recently released a book. So what was your influence really for writing it? And, we're talking about how it's amazing timing for it.
Yeah, amazingly in the bad way. So I've been studying markets and investing for 18 years now. And when I first started investing, the only way to really get information about it was primarily through books. So I've devoured hundreds of books about investing, about money, about finance. And I've read all of the classic books, and I just love them, right? One Up on Wall Street, The Warren Buffett Way, The Motley Fool Investment Guide. So many wonderful books out there about how to invest in the stock market, why the stock market does what it does, how you should just dollar cost average in, and you'll do very well over time. However, during that period when I was educating myself intensely, I never came across a book that answered the most important question that I had about investing when I first started, which was, why does the stock market go up? All of those books show that long-term graphic, right? That just shows bottom left to upper right. The stock market climbs this really, really weird, put investors on a roller coaster ride, but the long-term direction of the market is up into the right. And I'd never understood why that happened. And I'm the type of person that likes to understand the how things work. Like, I feel much better when I'm flying on a plane, knowing about Bernoulli's principles and Newton's laws of motions and aerodynamics and lift and the understanding the physics of how a plane stays in the air makes me a much better flyer. So I felt the same way about the stock market. I knew that it was a good idea to put money in the market. I knew that rich people, for some reason, put money into the stock market. I never understood why that was a good idea, or what was the forcing function that causes the market to go up over time. And I would just waited for years for a book to appear that just explained that concept very simply, but no such book ever appeared. So about 2 years ago, after talking with a couple of my friends, I decided to take the plunge and write the book myself. So I wrote this book not because I thought the world needed another financing book. I wrote the book because I literally thought that there was a missing piece of education out there, and I wanted to fill it.
Yeah, it's interesting. As you said there, sometimes it's really easy. I think we mentioned before, it's really easy to go to the complex stuff, but it's actually about starting at those foundations and understanding, why these things happen. And then from there you can advance, and then you have a better knowledge and better understanding, especially during these tough times.
Absolutely. Going back to like the first principles and what actually, how does the stock market work? Or even backing up from there, what the heck is the stock market? Why does the stock market exist? Or even explaining very simple terms that lots of people hear all the time, even if you know nothing about investing. I'd heard of the Dow Jones Industrial Average. I'd heard of the S&P 500. I'd heard of the NASDAQ. I had no idea what those terms meant. I knew it was good when they went up, and I know it was bad when they went down, but I had no idea what they were, why they existed, why they went up and down. So just answering those basic principles about the stocks and the stock market, I think, again, is just a big piece of missing education that isn't covered.
And what do you think are some of the other principles that that you mentioned in the book that are really important for people to know, especially if they're just entering into the markets? And you don't have to give too much of it away. People need to buy it because it's really, really great.
Yeah, there are many questions that I had about the market when I first started. Here's a really simple one. So I organized the book to basically be answers to a series of the most basic questions that people have about investing when they first started. One question that I had that I still think a lot of people who are investing today don't know the answer to is, who gets the money? When I purchase a stock, I go out and I buy Apple stock or Microsoft stock. Where does my money go? A lot of people think that it goes into Apple's bank account or Microsoft's bank account, and that intuitively makes sense. That's not what happens, though. 99.9% of the time, if you're buying a stock on the open market, that purchase you're making in no way benefits the company at all. You're simply buying that stock from another investor that owns shares in Apple or Microsoft, and you are giving them cash in exchange for the shares of that company. But even something as simple as that, I think, would be news to a lot of people.
Yeah, exactly. And that's the thing. As we mentioned before, it's like we all, I guess most people know how to buy stocks, that you can buy stocks, the companies, but it's understanding that I guess the foundation is below it. And, I know at uni, I've been studying, even clearing. So if you're clearing between different companies, even though when you sell a stock, it looks like it happens automatically, sometimes can take 2 to 3 days for it to occur. And that's, I guess, what we saw with Robinhood. So there's all these intricacies as well that I guess you don't really need to understand them to buy stocks, but it's a great thing to know, especially when, during volatile times.
Yeah, or even if you're going to be making an investment to a 401k. Here's a very simple one. When I was signing up for a 401k, which is a tax advantage way to save in America, it's the number one way to save. I was sitting down with my HR team, and they put this little paper in front of me, and it said, do you want the high growth one, the medium growth one, or the low growth one? And I said, I don't know. Which do I choose? And they said, oh, we can't help you with that. We're not allowed legally to give you advice about what to do. And I was like, well, I have zero education about what you're talking about. And this seems like an important decision that I need to make. So I said, high growth one. Done. Like that was my due diligence. I didn't understand what fees I was going to be paying. I didn't understand what my money was going into. I didn't understand why I should have faith that over the long term it was going to happen. And I think it's very common when people are in that situation. What do? They look at the performance metrics of whatever funds are out there, and they just circle whatever one's performed the best recently, right? This one's up 20% this quarter. I put my money into that. Yeah, I'll take 20% growth each quarter, having no idea what they're doing or no idea about the fees that they are paying. So the book was really aimed at people that are in that situation. They know they should know something about investing, but they literally don't know where to start. Just the other day, I was having a conversation with my friend who's an engineer. He's an entrepreneur. He's a very accomplished person. And when he started his job a few years ago, he called me on the phone because he was filling out his 401k. He was like, Brian, here's what I did. Can you just like double check this that like this makes sense? And I said, yeah, that all makes sense to me. And he's like, this is fairly complex. I'm a reasonably intelligent person and I was confused here. And I was like, yes, you can imagine how overwhelming these choices are if you have absolutely no education about them.
Yeah, and I guess they're the classic, like the engineers, the doctors, or the dentists. They're normally the people who might go it all in because they're intelligent people, but a lot of the times that's not how you successful investors is. Just the time and understanding, what to really look for.
Yeah, and the nice thing about investing is the concept of investing, how the stock market works, what the stock market is. It's not complex. If you can understand fourth grade math, you can understand everything you need to know about investing. That's not the problem. The problem is it's never explained to us. The problem is where that information is hidden from us, and it's often passed down within families. But once somebody explains it to you in an easy way, it's not hard to understand what the stock market is, how it works, and why you should have confidence that it goes up over time.
Yeah, there's so much jargon, but once you sort of break down what these words mean, it's like, oh, that's so easy. That's what I've really noticed. Like you read something like, oh, that's so complex, but then you learn what those words are, and it's like, oh, that's just really easy.
Yeah, it's like everything. There's jargon to every industry. The investment industry is filled with jargon. Once you understand the basic terms, it becomes much easier.
Yeah, definitely. So, in terms of the book, what do you think are the greatest misconceptions that you see people, maybe talking about when they come to you, maybe when they're beginners or just what they have for the markets?
Well, I can tell you about the mistakes that I made when I first started out, as I just alluded to. When I made my first 401k choice, the only thing I was after was give me the highest growing one. Like that's the only choice that I could have. So I think that's something that a lot of people do. And I didn't understand what stocks were, how they were connected to the businesses at all, the relationship between the two. I didn't understand any of that. So when I first started, I thought the way that you made money in the market was by buying penny stocks that would go up tomorrow immediately, right? It was just a big gambling machine to my mind. And if I'm going to gamble, I want the highest possible return immediately. And I think a lot of people take that mindset, especially, just witness what's happened with AMC and GameStop over the last year. A lot of people are piling into those names because they've seen the tremendous returns that those companies delivered in a short period of time, and they wanted to get in on the frenzy. If I was starting investing today at ground zero, I guarantee you I would be on Reddit boards, I would be buying AMC, I would be buying GameStop, I would be doing all the same things that those investors are doing today, because my mindset at the time was get rich, highest returns immediately, right? And it takes time and training and education for you to step back and realize how the markets actually work, what drives returns over short and long periods of time, and how you can compound your money for long periods of time. But that's a big mindset shift that I think people have to come to on their own.
Yeah, and it's there's been a few studies that saying, you look at ARK or some other indexes after they've had really high performance, like 5 or 10 times. That's normally when a lot of people put their money in, but it's normally when most of the returns have already occurred, and from there it's mainly losses. And I guess that's the thing to watch out for. Obviously not advice, but people should watch out for. If something's gone up a lot very quickly, you should be quite careful of putting money into it.
Yeah, the crazy thing about what's happening with ARK is the hyper growth that ARK had in 2020 has been met by the hyper crash that we've seen in 2020, 21, and beyond. But the interesting thing about that is that if you look back through history, it's actually fairly common for the best performing assets during periods of time, or the best performing funds during periods of time, for the investors in those funds to realize returns that are far lower than the funds would realize. My favorite example of this is happened between the year 2000 and 2009. This was a period when the US stock market did nothing. It was like flat. It had two crashes, one in 2000, 2002, and then another one 2007 to 2009. So the market did nothing. During this time period, the best performing mutual fund was called the CGM Focus Fund, run by a guy named Ken Hebner. He was a rock star. He delivered an 18% compound annualized return during 2000 to 2010, blowing away the market's return. Yet, if you invested in his fund, the average investor in his fund lost money. You invested in the best fund over a 10-year period and you actually lost money. Well, how could that be? This is where investor behavior enters the picture. When do you think people were buying Ken Hebner's fund? After it had a tremendous run. And to get those kind of returns, you're obviously going to have some volatility. When investors immediately experience volatility, what did they do? They sold this. The same thing happened with Peter Lynch during his enormous run. The investors in his fund got a much lower return. The same thing's happening today with Cathie Wood, despite her fund being, I think her fund's going to do great over the next 10 years. The question I have is, will the investors in her fund do great? Will they realize the returns, or are they going to bail whenever the inevitable downturn comes? So this is why studying how the market works, studying your own psychology, and adopting a long-term mindset are so important, because you can buy a great asset, a great stock, a great fund, and still lose money if your behavior is wrong.
Yeah, and that's important. And, my last interview guest, he was saying that it takes him 50 to 100 hours of research before he invests in a company. And, I know not everyone's going to do that, but I guess it just shows the importance of at least spending some time. Don't just go, as you mentioned before, look at a Reddit board and go, oh yeah, that's great, I'm just going to put my money in. Actually spend some time researching. And then from there, you can make a decision based on, your own investment philosophy and what you want to do.
Yeah, but research is intimidating to a lot of people. I know it was very intimidating to me at the start. First, didn't even know how to do the research, didn't know what research was required. It sounded like I have to do a whole lot of homework and a whole lot of studying before I make an investment. Who wants to do that? I just want to buy the thing that's going up tomorrow. But that research really goes a long way to building conviction in a company and knowing what you should be looking for and what pitfalls could potentially be out there. And that research and that conviction are going to be tested over and over again if you're going to be investing in a company. So taking the time up front to do the research that you need to really have conviction in a company will pay huge dividends down the road.
Yep. And then it doesn't stop there. Then you have to keep researching to see, do things change that would change your original hypothesis for why you invested? And if they do, maybe it's time to, exit and look for other companies. I think that's really important as well.
Yeah, very, very much so. Big thing that I've become a huge fan of is journaling. So before you make an investment, just jot down in a simple Google Doc, like I do, what you're buying, why you're buying it, what valuation you're paying, and what your assumptions are about that. That sounds like a whole bunch of extra work, and a lot of people are just like, forget that. I'm just gonna buy and just assume that I'm going to be right about the company. But I can't tell you how valuable that is for me to go back into my journal from years past and being like, once I know the results, right? If I bought a terrible company, what was I thinking at the time? What attracted me to this company at the time? What assumptions I was making that proved to be wrong in hindsight? Or conversely, if I made a really good investment, what did I get right about that company? Did the company just blow past my expectations targets? Most likely. But auditing yourself and auditing your own investing decisions is a very powerful exercise.
It's so important. And it doesn't take long. Sometimes it'll just be like 5 or 10 minutes, when you make an investment. I think that's, as you mentioned there, sometimes I know myself, I'm like, journaling, I've got to do that. And, but as you mentioned, it's just putting that little bit of time and then you can learn in the future.
Yeah, this is the price of investing if you want to invest in individual companies, right? The price of trying to get superior returns is you have to do research, you have to document yourself, you have to work on your mindset, you have to learn how to train yourself to do that. If that sounds overwhelming to you, no shame, just buy dollar cost average into index funds and call it a day. But if you like investing the way that we like investing, I think these are like table stakes for doing well.
Yeah. And if you think about it, like, for most people, if they have a job, they're earning money, it takes you hours to earn, hundreds of dollars or hundreds of pounds. And then you can easily just, think of something and put it on a stock in 5 minutes. So I guess it's thinking of it like that. How long did it take you to earn it? And then from there, actually taking the time to research
Very much.
might be a good way to do it. So I recently interviewed, I think someone quite well. We were talking about the book before, Nick Maggiulli, and he talks really about indexing. His focus is more about indexing rather than, I guess, individual stock picking, which is more what you do. So what is your theory behind being a stock picker and why you don't just index into S&P 500 or NASDAQ or something like that?
Yep. I love indexing. I think that 99% of people should index. I've read his book. I know Nick well. He's spot on. That is the correct strategy for 99% of people that want to do well in the markets. Just dollar cost average into index funds, and the odds of you doing well are very, very high. I can tell you for myself, all of my retirement funds, all my wife's retirement funds, all of that stuff is just on autopilot, continually buying into index funds. We don't even have to think about it or look at it or anything like that. However, I am into finance. I get joy out of researching companies and following the markets. Like, this is just a topic that interests me tremendously. I think that investing is one of the most fun activities I have ever come across. And I love how hard it is. I love how challenging it is. I love how new companies are coming public all the time. Valuations are changed. I think it's like such a fun activity to actively invest. That's why I do it, because I actually get joy out of trying to beat the market and learning lessons along the way and connecting with other people that are also trying to do the same thing as me. But it's not something that I recommend to ordinary people that have no natural interest in this stuff. I think that if you're in that small minority of people that are interested in finance, that want to do the research, want to study business, stock picking is a good activity. But for most people out there, they're bored to tears by talking about the things that we like to discuss. And for them, dollar cost averaging into index funds is a completely valid strategy.
It's definitely a bug, isn't it? Once you catch it, it's hard to, to look away from the research and the stocks and everything like that. So we mentioned, obviously there's been a bit of capitulation over the past few months, maybe a year, for a lot of growth stocks. So if you were a new investor, maybe you read the book, you're a new investor into the market, what decisions and actions would you take personally to maybe, learn, or just to position yourself to a point where you'd be able to do as well as you can?
Yeah. So before you start investing, I think it's really important that you get your personal finances rock solid. So I think that investing is step like 13. Investing in individual stocks is step 13. But before you do that, you need to make sure you have a solid, reliable, growing career that can bring income into your life. You need to be paying down your debt, eliminating all your consumer debt. You need to have a place to live that is affordable to you. You got to make sure you have an emergency fund figured out, right? Those things are what you should focus on first. So if I was to go back in time, I'd tell myself, make sure your personal finances are rock solid. That is going to provide you with so much mental comfort and clarity once you start putting your money into risk assets such as stocks, because dealing with volatility in the markets is hard. Dealing with volatility while you're simultaneously worried about your job or worried about paying your bills or you have credit card debt is an order of magnitude harder. So I would tell myself, make sure your personal finances are rock solid. Put your capital into that first. Then you can invest with confidence.
Yeah, it's really important. And I know you've actually been doing a series recently on your YouTube where you're talking about, if you were to start your portfolio right now, what companies would you put into that? And I think you've mentioned Shopify and Micardolibro at the moment. So I guess why those companies? And then, can you maybe give us a bit of an insight into what maybe other companies you're looking to analyze in the near future?
Yeah, sure. So we thought we started a new series on our YouTube channel, to your point, where we're going to be investing $250 per week into essentially our favorite stocks at any given time. Right now, we think the blue light is flashing, and it's a great time to get into to growth stock investing, because so many of these companies have just been eviscerated. Their valuations have come back to earth, and their stocks are down tremendously. But we still think that a lot of the companies that are out there still have tremendous growth runways ahead of them. And the time to really get interested in these companies is after they've taken a fall. So two that you just mentioned, Shopify and Micardolibro. I've personally owned those stocks for several years. Micardolibro, I'm coming up on a decade of owning. And the thesis for both of them is largely based on e-commerce growth, right? Shopify is the number one alternative to Amazon around the globe. Has a tremendous leader, great financials, huge growth runway. Very similar story for Micardolibro. It's essentially the Amazon / PayPal / eBay / Craigslist of Latin America, which is a fast-growing, emerging market. Great leadership, and just a lot to like about those businesses. And as I said, I have owned Micardolibro for almost 10 years now, and the overall portfolio position for me is up huge. It's just gigantically up. But during that time period of owning this company, that's literally like a 10 or 20 bagger for me overall, I've had to endure numerous pullbacks of 50% or 60% or more. And every time that happens, it feels awful. It feels awful to hold these companies over short periods of time. But as long as the financials continue to move in the right direction, as the company continues to get stronger, I'm very confident that the long-term trajectory for Micardolibro stock is still up and to the right. But the way that it works is that every week we alternate. So me and my business partner, Brian Stoffel, I pick a stock one week, he picks it the next. We pick the stocks based on our investing criteria. We're looking for companies that are the best fit for our investment portfolio, and whatever companies are also trading at the most attractive valuation that we feel at any given time. Now, we started this about a month ago, and the markets have been straight down since we essentially started this portfolio. But to your point, we've bought Shopify, we've bought Mercado Libre, and we're going to continue to buy our favorite growth stocks, hopefully for many, many months and years to come.
Yeah, and I think it's important, if anyone's entering the market, most of these companies down 40, 50, 60, sometimes 90%. And, as long as they're still growing and as long as the company's better than it was a year ago, they're a great position to potentially invest and, hold it for the long term. I think everyone complains that, the prices markets are too expensive, stocks are too expensive, until they go down and then they freak out that, they've gone down.
Yep. Everybody says, I can't wait for a pullback until the pullback actually comes. And they realize that the reason that the pullback here is usually because there's something bad going on in the world. And you don't want to be buying stocks when the world feels like it's falling apart. I mean, right now we're dealing with record inflation, right? Supply chain challenges galore. There's a war going on. Bonds are off to their worst start in basically on record. Real estate is likely to be facing some challenging times ahead with interest rate arising. And it's like, what are you supposed to do with your money? What are you supposed to do? Like, every choice that you have out there is bad. But for me, the answer in the long term remains the same. I want the vast majority of my net worth in the stock market, specifically in high quality companies. And I plan on buying those companies and holding them for long periods of time. I know that if I do that, and the world continues to do what the world does, the odds of me having a very big smile on my face 5 years from now, 10 years from now, 20 years from now is very high. But the price of growing my wealth, the market growing my wealth for me, is living through periods like this, living through periods when it feels like investing is impossible. That's how investing feels right now. It feels impossible. It's not.
Yeah, definitely. And I think that's the Warren Buffett where he says, 5-10 years time, most of these problems should hopefully have gone away. But as long as the companies are still growing and improving, then they're going to be in a better position in the future. So do you sort of look at that rhetoric as well? You don't really worry about the macro as much?
Oh, very, 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 very much. And I was even thinking today, in 2020, at the end of 2020, my portfolio was like at an all-time high, but my social life was like at an all-time low because everybody I knew was indoors, scared to death of COVID. Today, my social life has returned back to an all-time high with everything opening up, and my portfolio is at an all-time low. Given the choice, I'll take today. I would much rather have a thriving, happy social life than a thriving, happy portfolio. Hopefully, in the not-too-distant future, both of those things will be going well, though.
Yeah, it's the thing. And that's the thing. You don't need the money now. It's not for, this portfolio isn't for now, it's for the future. And that's why you're thinking about the future rather than freaking out about today.
Very much, very much so. Yeah, you always have to remind yourself of that. What are you actually investing for? What is the purpose of that capital? If that purpose is to have a really good retirement or to be able to buy things 5 and 10 years from now, what happens in any given month, day, week, quarter, year shouldn't really bother you that much. And if you are using that money, hopefully to pay for like a down payment on a house, the stock market's not the place to put that capital that has an expiration date on it and a need on that. That should be in boring riskless asset, risk reduction assets like bonds and cash, even though those aren't a great place to put capital right now and the returns aren't great there. If you know that you're going to need that money in a definite date in the not too distant future, it's better to have that in a very safe asset that's slowly losing value than one that could quickly lose value.
Yeah, I think that the past few months has proven that in inflation, people thought, oh, stocks are maybe inflation hedge. Crypto's inflation hedge, gold's inflation hedge. It's like, no, not really.
Yeah.
So if you need it now, you got to, as you said, you got to be smart with it. So
yeah,
Brian, thanks so much for joining the podcast again. And just on to my last question, I guess, what is one message you'd like people to take away from your book, if it just one?
Yeah, the ultimate message of the book is just think long term, right? If you judge the stock market over its intended holding periods, intended time frame, which is measured in years or even in decades, the stock market is a very low risk place to actually make money. It's a dependable place to make money in the long term. However, it's an awful place to try and make money in the short term because the volatility is so high. So when you're going through tough times like we're going through right now and you're looking at your portfolio and it's down and you just see red, just keep zooming out. Just keep focusing on the long-term trajectory of the market and focus on that. If you can truly adopt that mindset, think and invest for the long term, the odds of you doing well are overwhelmingly high.
Yeah, definitely. And we talked last time about, a framework and having this philosophy and understanding that if something changes in the framework, maybe it's time to get out of the business. But if nothing has changed, maybe it's time to keep it. So I think that's, important as well. I guess people can watch that episode if they want to learn more about your framework and, what you look for in a company.
Sure.
Perfect, Brian. So thank you so much again. So as you mentioned, the book was released a month ago. It's doing very well. So if people wanted to buy that, would the best place be Amazon, anywhere else?
Yep. Amazon, all major booksellers. Amazon's like the 100-power gorilla in the room when it comes to book sales. So that's the easiest place to send people to.
Yeah, perfect. And I'll put, you're also very active on Twitter and YouTube. So I'll put those descriptions below. And I would definitely recommend Brian's content. I watch it almost religiously. Whenever a new video comes up, I'll click on it. So yeah, Brian, thanks again for joining the podcast.
Thanks so much for having me.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.